Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on a diversified high growth portfolio. One of the better known diversified high growth ETFs on the market is Vanguard's VDHG. So we're going to do a few exercises based on its current target asset allocation and go back in time to when the managed fund version started 20 plus years ago and see what the differences are. Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make a step to sign. These are simple concepts. We'd like investors to better understand risk so they can make informed decisions. So target asset allocation, and this is a target asset allocation for the VDHG ETF. It rebalances when weightings are 2% plus or minus. And to note for this exercise, the specific global aggregate bond option used is a limited amount of data. So I've substituted it out with a similar option so we can go back as far as possible. So you got any thoughts on this construction, Peter? It's what we'd call a 90-10, but depending on how you carve them up, there's many different 90-10s out there.
Absolutely. The thing that I'm looking at here that sticks out to me is that today, a 90-10 portfolio probably always is going to have a bias towards global equities. I think that over time, we've seen the home country bias towards Australian equities gradually changing in the minds of people who construct portfolios, fund managers, and other investment professionals. So yeah, that home country bias has changed a lot. If I'd looked at this 20 years ago or 30 years ago, I'd be certain that the Australian equities would dominate and global would be lesser. And today, on this example, it's 54% global equities when you consider all sectors to 36. So it's actually 3-2 the other way.
And historic target asset allocation, as you said there, you go back a few years and there's a very different picture and there's many different 90-10s you can construct. And as you can see how things have changed over the years, these were the target asset allocations in 2003, 2006, been on there in 2009. The most obvious thing to me is initially how much higher the weighting to Australia was on the growth side. You got 48% in stocks, then another 10% in REITs. Then by 2006, the REITs were split 50-50 between Australian and global. Then by 2009, the Australian allocation went down to 44%. And then they included 4% in global small caps. So what does these changes say to you, Peter?
What it says to me is that over time, the managers have actually sought broader diversification and reducing their exposure to Australian assets. So, you start on the left, and the allocation's 58% just in the growth assets. When you get to 2006, that 58's now down to 53. And by the time you get to the right-hand side, that allocation is now 49. There's a very strong trend towards global assets and a strong reduction over time towards local.
And periodic performance. So I went back and constructed that initial target asset allocation from 2003, which was actually started in 2002. Along with the current one. And for all the changes since 1999, with this one as far back as we could go, you end up with the exact same result. And you look at how close some of the other results are. Now, obviously, this is index and there's no taxes, fees, and they're both rebalanced annually, not a 2% change in tolerance. But it's interesting how one thing that started off in 2002 and then compared to what its current target asset allocation is, they're exactly the same.
Yeah, look, the end result across that period is identical. For all the efforts to try to improve the structure, the net result is, some marginally better performance in the recent times and not in the long run. So, it suggests that the allocations in the early part of the period were better with the old. The allocations in the later part of the period were better with the new, but by the time you add those two different time series together, you end up with the same outcome.
And another periodic performance, and this time is against the indices that comprise the BAS VGS split at a 30-70 bias towards global. And the longer term numbers with the VAS VGS option are dragged down due to the heavier exposure to MSCI World, which was beneficial over the shorter time frames. And I'll make one point here. If you're using an all-in-one ETF, that's probably the return that you're going to get. And the bottom one is annually rebalanced also. But if you're doing it yourself, you have to navigate the individual performance differences and the behavioral issues that may come along with having various different assets within your portfolio and watching some things underperform and some things outperform. So you may find yourself underweighting and overweighting things based on recent history. So you may not actually get the result, whereas with the all-in-one ETF or portfolio, that's probably what you're going to get.
Absolutely. I think that there's a clear message here that taking the approach in the top half of this table is without doubt a superior long-term option. And as you pointed out, there's probably a bit too much potential for investor ill discipline in the bottom option.
And growth of $1, and the long-term result between the two is about $1 over that time period. Now, there are other considerations with fees and tax drag and how these all-in-one ETFs are constructed, but we're just going to focus on an asset allocation decision for this video.
The aggregate outcome there is about a 15% higher portfolio value. That's not insignificant. That more automated rebalancing, broader diversification, etc., that it's happening automatically, it's showing real value.
And range of return. So the worst is about 30% down for 12 months and a little over 30% up for 12 months. And
absolutely nothing out of the ordinary. That's exactly the sort of pattern that historically you would expect for this style of portfolio for sure.
And rolling annual returns, we'll just roll on to the one that includes both. And the blue is the VAS VGS indices, and it's more pain during that .com bubble, 9/11 Iraq War period. But since 2010, the highs are much higher with that less diversified option of just the two indices.
Again, this is a classic outcome for a lack of diversification. The lows are worse, the highs are better. But as we've seen, the long-term outcome, the broader diversification is a better result.
Historic chance of a positive or negative, and again, this is pretty much what you'd expect. But if you had a diversified portfolio, you wouldn't want to be seeing a chance of a negative return over 10 years anyway, would you really, Peter?
No, you would not. I think that, if you're going to stay broadly diversified, if you're going to use, index style portfolios with that diversification and regular rebalancing, anyone that's had a negative result over 10 years, I suggest that they've either tried to do market timing unsuccessfully or they've had very concentrated portfolios that have underperformed. But a broadly diverse portfolio of a high growth nature, 10 years, you definitely expect a positive result. That chart to me looks exactly what I would have expected.
And largest fall in time to recovery, so 38% down during the GFC, and it took about 5.5 years back to square.
And important to recognise that individual markets, some of them were vastly worse than that. A minus 38, in the context of the GFC was reasonable. 65 months to recover, 5 years, 5 months. Again, that's consistent with my understanding of historic market results, and that's about as long a negative return on a global scale as there has been.
And risk return or efficient frontier. And I guess most of the efficient frontier charts we post probably aren't that interesting because they haven't combined anything yet, whereas this one's quite valuable, I think, because it shows the portfolio as the green diamond, and then you've got all the assets within the portfolio showing how they perform. So you can see how your portfolio behaves and how everything within it behaves at the same time. It's 90% growth, so all the risk assets are to the right, but then you combine them all together and it lowers the volatility and you get sort of a midpoint return there.
I love the fact that this page in isolation validates, Bill Sharp's work on risk and return, and also validates Harry Markowitz's work on diversification. On the left-hand side of the chart with lower returns and lower volatility, you've got the bond portfolios, and over on the right where the red dots are higher but further to the right, you've got the equity portfolios. That's Sharp's, risk and reward being related. And then, Harry Markowitz, comes along and says, well, hang on, but if we diversify genuinely different asset classes, we'll get lower volatility, but still get the returns. And lo and behold, the green diamond is above the two sort of red dots to the right of it. And the other red dots the other three further to the right of it. I think it's a great reminder that Sharp's work's still valid, Markowitz's work is still valid, and investors should heed both. And sources in the descriptions of data. Thanks for your time. Okay, thank you.